And so when we sat there, we're like, I mean, Houston's one of the biggest markets in the nation.
Yeah.
And I'm like,
it's right down
Luke's
the street.
done 20 deals there. I've done half a dozen deals there. And we already know the brokers. We already know the guys. Like, we're already connected and plugged in. We know have the engineers. If we can't find a deal in a metro of 8.5 million people, I mean, like, we're not very good at our jobs. Yeah. I think it's investor sentiment at the end of the day. Like, when you think about Houston on the exit side of it, the liquidity is so tied to perception and optics.
Yeah.
People still give you the, I don't know, Houston's an energy market. And you're like, guys, I'm like the largest medical center in the world is in Houston. I mean, when you think about that diversification, and 10 years ago when we were doing that deal in West Creek, Tim, it was like, we had Brookfield saying the same thing. And I'm like, guys, if you look at that, that reciprocation or whatever, 80% of the jobs are tied to energy and mining back in like the 90s. Like 30% of them are tied to them today. And so, yeah, that's a big exposure, but at the same token, it's broadly diversified.
Yeah.
There's all different types of things. I mean, there's 8 million people down there. So I'm like, you just run the mechanics of it, it's huge. And like, again, it's top in the nation in terms of population growth, job growth, all these types of things.
I like this commercial, Zach.
I was going to say, maybe we should save this clip. This could be like the intro. It could be just like all Houston.
Yeah.
Hey, I don't think we need an intro. I think we just keep going.
This is the Texas Land Guys podcast, hosted by brothers Tim Dosch and Tom Dosch. With their partners David Marshall and Trip Rich, they have built DMRE, the leading land brokerage in Texas. With decades of experience brokering deals between landowners and real estate developers, they take you inside the deals that move the market.
Let me tell you what's wrong with Houston now, though.
Well, I was going to say, I don't know if Tim hears what we hear up here in Dallas about Houston when they're not talking to Houston guys. I'm sure they hear some of it, but people are pretty bashing on Houston up here. It's crazy. Yeah, but
we have a pretty thin,
there, so
I would say Houston has a pretty thin list of people that are we think are truly interested in Houston. You know, I mean, it's probably like 5 to 7 groups who are really going to do Houston deals. And then there's people who kind of kick tires and come down and meet with us, but it's not like a really long list of groups that are actually going to really do a deal in Houston.
Yeah. Well, and I mean, how's the old guard of Houston doing? Like, you mean, obviously, like finger companies kind of, that's a different world. You have
they're gone. Yeah. Martin Fine is no longer, they're not really active.
Couple deals, but not.
More the thing is, like, some of these guys that are so prolific down there. I mean, Hines is obviously, I don't know how, like Hines and Hanover, I mean, they do these towers that are gargantuan cost bases, and they sell them for like 70 cents on the dollar 10 years later. And you're like, I don't understand how do you make money off that?
Yeah. But it seems like Hines is becoming more like investment management than development. I mean, from what most of their developers have left. Yeah. At least on the multi side.
Yeah.
So,
Dinnerstein and Morgan are still.
That'd be the one that with the passing of the guard to Philip, and I think just that hasn't happened with a lot of these other companies. Yeah. They just kind of ridden off into the sunset. So. But then TCR and Alliance, even though they're not Alliance the old guard, but like they do so much down there.
Have 10 deals down there. I mean, as long as you've got all the guys down there, I mean, they're going to keep rolling. But that again, that's almost driven by the volume, because like without the volume, they don't get the pricing power, they don't get all the preferential treatment, and without all that stuff, you just kind of like, man, I don't how you can compete. Yeah, they always had that cost advantage over everybody. Where you're like, you're $40,000 a unit less than me total cost. Like.
Which you guys compete pretty well with them now, right? Or can?
Endeavor does, for sure. A lot of what we've done at Endeavor, a lot of what was done prior to me even getting there was very similar. It was like, if you take that attainable concept and model, but if you go and you sort of break it down and say, well, how do I save money on the structure versus like the interiors? You get a lot of times, and I mean, this has always been throughout my career. It's like when you get to the end of the job, you need a couple bucks on your hard costs. Like, all right, what are we taking out of the specifications and the finishes? And you're like, well, that's what actually sells my job. Like, if I get rid of hard surface countertops and go with Formica, which hadn't happened for 20 years, but it's like if you start skimping on all these things, putting more carpet in versus some of the vinyl floors, or going down on like the quality of your plumbing fixtures and stuff. That's what your tenant sees when they walk into the door. So you got a deal that's whatever it is, $200,000 a unit hard cost budget, and then you save $5,000 a unit. That's like the most important $5,000. And so that's always been the challenge. So with Endeavor and the way that these successful attainable deals have been is, how do you save money in the structure? What can you do to eliminate a lot of the waste and facilitate the labor? That's really kind of the key, I think, to getting into the savings. And so we've been able to lock in designs that our subcontractors that are building them have signed off on. And so if you look at it and you say, the dimensions of this room eliminates all the waste. It may be a 12 by 12 dimension versus a 11 by 13 dimension, but because you don't have those awkward drywall sheets maybe come in 6 foot sections, and so you're just putting 2 up versus cutting it and throwing away that 1 foot. You're getting charged a material for that 1 foot. So your waste coefficient that your labor or that your sub charges may be 10%, 15% higher. So it's getting them to acknowledge and eliminate some of that on the design front that really helps you get your savings. But you got to design everything up front. So it doesn't really work in the mid-rise, in the urban components, because you're designing everything to fit the odd angles and jogs.
Custom.
That's right. Yeah. So you can try to do it. And we've morphed into, how do we create really efficient mid-rise buildings? And we're doing that. But clearly that's the challenge with it. But so we've been able, I saw a really significant price difference from where I came from to where I am now. And again, the quality on the interiors is equal or better. And so it's really the savings in the structure.
Yeah. That's incredible, because the renter doesn't notice that at all. In things like waste. Yeah. It's just waste. So it's like, if you can cut that out, that's right to the bottom line.
Right. That's right.
Wow. It'd be interesting to hear, because I wanted to talk about the deal in Corinth, because I think it'd be cool to have specifically about that deal. But then I think it'd be interesting to hear a little bit more. Like, I didn't realize you'd done deals in Oregon, and I knew you did some of the student housing stuff, but all over the country. I know we could probably spend a lot of time talking about it. So maybe it's more just like, what was it like to go do a deal in a place like Oregon? Like, how do you get anything done in some of these, where it takes a lot longer, right? There's just a lot more regulation and...
Yeah, obviously every market has its kinks. And that's always been the biggest challenge with student housing, is when you get into a market, it's like, I've never been there. I got to go find an engineer. I got to go figure out like who's who in, political side, if you have to go through a rezoning or if you need a variance or something. And so just kind of going back, like I started at Fairfield when I was a sophomore in college. I was 18, and I was, one of my really good friends in my fraternity was like, hey man, you need a job. Like, this leasing gig is great. You get paid big bonuses for leasing apartments. Just call your friends and have them lease here. And like, it's a pretty good deal. You don't have to do anything. I'm like, this sounds awesome. And so I started as a leasing agent at one of the student housing properties. And it was one of the first ones that Fairfield had built at the time. And it was this mega huge deal at Florida, and it was like 1,044 beds. It was like 400 units. It was just.
So were you University of Florida?
Yeah.
Okay, I didn't remember that. Okay, yeah. That's a massive deal.
I think it's the Harvard of the South. Is kind of what they call it.
I heard that. Yeah, the Gators.
That's right. And so I started out as a leasing agent, and it was a disaster. I would just say we had our entire management team and maintenance team kind of just blew up right before what they call the turns, like when everybody leaves, and student housing, everybody leaves. And at the time, this was 25 years ago, like we had 7 days to get all the units ready. So everybody moves out, on a Sunday, and next Sunday you got 1,000 people,
and they destroy the units. The students do.
It was tough. They move out. Like it was pretty rough, and so. Throughout the year, you have all these checks and balances, like quarterly checks, walks, maintenance thing, all these things that are just so standard in student housing today. But 25 years ago, they didn't exist. It was just a bunch of people managing stuff. And the end of all of it was, in my first year there, we had done no preparation at all. And the leasing agents, we had no idea. But our entire corporate office kind of come in, and the week of turn, like a day into it, everybody got fired. So our property manager, assistant manager, our bookkeeper, our maintenance lead, our assistant lead, they all got fired. And we had this team of corporate people that came in, and they were like, all right, guys, it's going to be a rough week. So we're walking units. This is also kind of during, the time frame where like we have finals and stuff. Yeah. And so you got a bunch of 18-year-old kids that are like, this isn't my problem, guys. This is like the Fairfield problem. But it was a total disaster. we had people moving in and things weren't ready. And we had a lot of people that were in hotels. And like, we really, the people that were there, I mean, I worked for 48 straight hours the 2 days before, like cutting keys and getting ledgers ready of like, these units aren't ready. These units are ready. These people, like we actually had to figure out who was living in which rooms. And you have, kids that just move into another room. And when the roommate moves out, and you're like, you can't do that. Yeah. You renewed your lease in this room. So, I mean, it was crazy. So the long story is that, when we got out of it, we had nobody there. So we had all this corporate support, but I ended up managing the property after that. So I was like an assistant manager.
This is while you're in school?
Yeah. So I was managing the property, and I was like president of my fraternity, and I was going to school full time, and there's just a lot going on. And so I took my senior year in like a summer session so I could just like check one thing off. And so I kind of like hurried up to get through school, and I graduated. And then, we ended up selling that property. It was like one of ACC's first real big deals. And so we sold it, and I had graduated. And so a roommate of mine who worked for me at the time, he came with me, and we got shipped out to San Marcos.
Okay.
And with Fairfield. So we're like, yeah, we'll go work on another property. And so we'd already graduated. And so, you're 22, you live in a free apartment, and you're like, this is the greatest job in the world, just, managing student housing properties. Yeah. So we went out there, and then we did that for a little bit. And then I ended up like taking over the operations for Fairfield and working as a regional. And we had 8 or 9 deals at any given time kind of throughout the country. And that got me a little bit more exposure to different markets and different processes. Like I worked on new construction. We worked on the sales side of stuff. We kind of worked with all the different components. And I had a lady who was really kind of like less of a mentor, but more of a grandmother at Fairfield. And she was awesome. Like she was always there to kind of propel you. And she really took care of like the people that she really liked. And so she was always like, well, what do you want to do? And I'm like, I don't know. I'm like, I see a guy flying around in a private jet. He's a developer. Like, let's do that. Like steak dinners and planes. What else could you want in life? And so I ended up coming up and doing the development. And student housing was a great inroad because most of the guys that did it, they'd do it for a few years. And then it was kind of like they'd get married, they'd have kids, they didn't want to travel as much. It kind of aged out of it a little bit. And so they would like pass it on to the next young person that wanted it. And so then you fast forward and you're like, all right, you're 25, you're going to all these student markets, you've got a corporate credit card, and your due diligence is like going to a bar at night and talking to kids like, hey, where do you want to live? Like, would you live here? And it was awesome. So it was really a lot of fun when you're young and you're traveling. I mean, I was on a plane twice a week. I'd go somewhere Monday, Tuesday. I'd be in the office, like Tuesday night through, and Wednesday, and then Thursday morning or Friday, I'd fly out to another city and come back. And so, I mean, there's a lot of travel, and that got me into the development side of it. And with Fairfield, it was really like, hey, jump into it. There wasn't a great tutelage program. There was a lot of great guys that would give you a ton of wisdom, but you just have to go sign something up, and you kind of learn by screwing up. It's like you get some incredibly environmentally hot site and be like, hey, let's go build right here. This is a great site. And like, you can't do that.
Yeah.
And then you're like, why? Oh, it's because of contamination. Oh, that's weird. You can't build on that. Okay. And so there was just a lot of kind of learning through experience there. So that's what got me into the student housing.
Wow. Okay. So I did leasing in college too for Asset Plus.
Oh yeah. So Mike McGrath and Ryan and those guys.
Yeah. So I did that and like lived at the dorm. And so I've not turned to the extent you did because we had like half the size of a property, but I can relate a little bit to what you're saying in the regionals and the guys and girls in those roles, all the traveling and totally like kind of living the college life, but 3 years out of college. Mm-hmm. So I could see how you would age out of that and be like, it's fun for a while. And then you're like, okay, I'm ready to.
Yeah, you're 27, 28 and you're at a bar. People look at you differently than when you're 24. Yeah. It's like, maybe it's time for me to move on.
It seemed like it's a grind too. Just kind of watching what I know there's the fun aspects, like the social aspects, but kind of a grind too, just how hard some of those people work. And
I mean, the operations is totally a grind. Again, I was a manager and like, it just, there's so much, you've got all these tenants that want to be treated like adults. And, we can all today relate back to when we were 18, 19, 20 and thought we knew the world and wanted to handle things ourselves. And then like you think back like, golly, what an idiot I was. And so you're managing all this. And then you've got the big, like when you go build a really nice student housing deal and you're getting the top end rents in the market, they're guarantors. I mean, parents are doctors and CEOs and attorneys.
Yeah.
You know, powerful people that don't want to hear that Johnny's not doing what Johnny's supposed to be doing.
Yeah.
So it's a delicate balance. You're just as much therapist as you are kind of manager at that point. So it is an interesting world. It's very challenging. On the development side, to your point, it is tough because one of the first deals I did was in Lawrence, Kansas. And I mean, Lawrence, Kansas it's a cool little college town. But I mean, it's just, you're in the middle of fields in Kansas, you get there. And again, like you're trying to find who are the civil engineers that really know this place? What are the got-yous in the development process? What about this? What about this? And so you're trying to figure out how the process works. And at the same time, you're also trying to go out and raise money. And so when you get somebody to come in, you're trying to fly somebody in and explain to them the city, you have to understand, you have to know the city. So I'm like, you're doing a crash course in what's the history, what's happened here, who developed this, who is that guy? Why is that guy significant? And you're learning all of that really on a quick timeline just to be able to figure out if you can go do this deal. And then you're out. Like, it's like you can only do so many deals in a college town before you saturate the market. So it's not like you can't have 4 deals in DFW and have 4 deals in Lawrence, Kansas. It doesn't work that way. So I'd have years where like I have a deal in LSU, a deal in Charlotte, a deal in Kansas. And I mean, every week you're like, all right, I got to get to this planning and zoning meeting out here and I got to get to this piece over here. And so,
So how did you transition, Zach, to the market rate side of multifamily from student housing?
So once the recession hit, student housing was the greatest thing ever for me because like at Fairfield, we probably had 45 originators, developers, acquisition officers, guys that were buying and building throughout the nation. We had 16 satellite offices. Well, the recession hit and we came out of it with 5. And it was like the consolidation in 2009 was or 8, 9. I mean, it was so real, but there was nobody doing student housing but me. And so I would have been like the least qualified guy at the time to keep, but I just had this little empire that nobody touched. So I was completely safe. And I was probably the cheapest person by tenfold, so that helped. But it kept me on for a reason. So when we came out, it was like, hey, we wanted a guy in Boston, we wanted a guy in DC, a guy in Atlanta, a guy in Dallas, a guy in California, and then it was me.
I was going to ask where the markets were. So those were the markets. Yeah.
That was it. And so each of us, we were the asset managers, we were the developers, which nobody was developing really, but we had some things we were finishing up, that we came out of there that had already started pre-recession. And, we were the acquisition guys. So we would underwrite new deals. It kind of like forced everybody to go back to being more of a generalist that could look at and hold a lot of roles versus just being siloed into I'm going to go find land and I'm going to entitle land.
Yeah.
And so we modified a ton of debt. We did all that stuff. So you came out of the recession and I was the student guy. We did a couple things coming out of the recession in student housing. I'll never forget. I built a deal in LSU that was like a 12.5 return on cost. And you just don't see that a whole lot.
Gosh,
it was crazy. Yeah, it was wild.
Wow.
But as we were going through, Fairfield was bought out by Brookfield Asset Management. So Brookfield came in. They were the controlling partner. CalSTRS was a minority partner in the company. And Brookfield had done some student housing, but it hadn't gone really well. And so we would raise outside money for it. But internally, there's always skepticism. Like, why are we doing this student housing thing? Like, is it really going to work? Is it really going to make money? And on one side, I'm going, I don't know, 12 return on cost feels pretty heavy to me. Should be able to make money. But it just wasn't a thesis that they really embodied. And so same time frame, we kind of had some turnover in our Texas office. And so I was looking around like, well, everybody wants to be in Texas right now. I live in Texas. We have an opening. So I just kind of naturally took over the Texas stuff and I was doing both. And then it was kind of like, look, again, like developers were like water. We're going to go the pathway of least resistance. And so if the capital and the markets, and everybody wants to be in Dallas. I'll just start doing Texas stuff.
Yeah.
And then we kind of wound down the student. And at the time, I became a little bit more disengaged with student as a thesis. As soon as student housing was trading like at or below market rate product and premium wise,
just didn't really make sense anymore.
I didn't get it. As a fiduciary of investors' capital, I'm like, man, if I can build, who knows what the time was, if I can build to a 7 return on cost on a student deal and I can build to a 7 on a conventional deal, I feel so much more confident about investing your money in a place where I understand the liquidity, the supply and demand imbalance is way easier to manage. These student deals, like we built in one market, LSU, it's a 98% occupied market. There's like 6,000 beds that came in over a 2-year period.
Wow.
And part of it was university. Then there was like 7 off-market. It's because the market was so good. It attracted so many people. It'd be the equivalent of having like 800,000 units in Dallas built today.
Golly.
I mean, so when you think about it, you're like, that would raise a few eyebrows in Dallas. And so that market went to like, 75, 80% over the course of 18 months. Yeah. And there's nothing you can do about it in student. So there's this inherent risk. There's a risk in kind of long-term rent growth with product out there just because newest and greatest always kind of outperforms. You've got this captive audience that can grow, but I mean, how much can it really grow? And so you have all of this stuff and I'm like, man, it felt like it needed to trade at a premium, but you had the whole resilience factor coming out of the recession where student didn't take that big hit. And so all these investors wanted to be in it. So it was flooded with capital that was driving rates down and it was trading like at or below market rate. And so it's like, I just trying to internally pitch strategy. And I'm like, guys, I think we need to pivot. I don't think I can, I think we can put good deals together, but I don't think it makes sense given we also have a market in Texas that's vacant. Yeah, you can go hire somebody. I'm like, but I'll take that one.
Yeah.
And so that's when I took over Texas and, we started doing deals. And one of the first sites we bought, Tim, was with you and David and Tom down there in West Creek. We bought that with Brookfield where we would go build the big towers and stuff like that. And so we just kind of jumped into it. So that was the foray into market rate housing. And, even with Fairfield, we started looking at like Arizona. And so, I mean, we had 6 people. So as we started to get back into these other markets, it was like, hey, we built a ton of stuff out here. Let's go kind of reset the brand and go see what we can do. And, so I spent time in Arizona was another big one, but.
So you were still traveling, not even just doing Texas.
Not a lot, but I kind of did. I mean, I kind of started to do stuff in other markets a little bit too.
Was your last deal with us in Houston before you moved to Endeavor? Was it the deal in the Heights?
Yeah.
Bill Franklin's
that's right.
property?
Yeah.
Mm-hmm. Yeah. You did quite a bit in Houston just while you were there over that, however many years that was that you switched into market.
Yeah, because you had the 6th Street deal too, right? In the Heights.
Mm-hmm. Yeah, on the south side there. And then we did, that was actually, it was right around the same time
that was
Sawyer Heights.
Because that was towards the end there too.
Mm-hmm.
Yeah.
And that actually may be one of the best. I love that
site.
deal. Like, the product, have you gone by it?
I have, yeah. Yeah, it looks really good.
I mean, it's a cool building.
It's a great location too. It'd be a cool place to live because you can access the park there, the Bayou Park and all that. So what about Austin? Were you doing a lot in Austin too during that time?
Yeah, well, I mean, we did. The first deal we did was the one off of South Lamar, 2525. It's so funny watching, Austin has just been, it was on such this like cataclysmic growth trajectory. And I remember we signed this site up and we kind of knew going back into Austin, anytime you go back into a market and you're like waving your flag, I mean, you guys know this because you're like, hey, Fairfield's coming back. And you're like, okay, sure, maybe they'll close on the site. Like, you got to have to overpay.
How do you know what we're thinking here?
Yeah. Let's see if this guy can perform.
You get the call from these developers you haven't heard from for 3 years. Yeah. And you're like, we're going to do 6 deals this year.
We're doing you a favor by coming back to your market. Yeah, I know. So we knew we were going to have to get aggressive and overpay. And we kind of got into that site and we liked it because, brochure wise, it was great. You're half a mile off of Ladyburg Lake and South Lamar corridor was really cool. And we signed it up and we're like, okay, we'll go develop this deal. And it's funny because it was shaped like the state of Texas. And you had this little 60 feet of frontage on South Lamar. And then it kind of ballooned in the back. And it backed up to the railroad and the creek, and you had Borden neighborhood on the one side, Zilker on the other side. And it was the most complicated deal ever. And it was just pure Austin, not horror stories, but just like back and forth. You had like the city had a new transportation person that came in 9 months into the deal, and they decided they didn't want our entrance to be off South Lamar. And we're like, well, it's impossible. It's the only frontage we have, the protected tree clusters. And we had utility easements, issues. And so that was almost like a 6-month issue where we had to get to the city manager. And this was our first deal. So we didn't have the ability to just go call the mayor and have him talk to us. Like we didn't have any of that pull. And so trying to solve all these issues, and, it was a challenging design. You had to get fire coverage and loop everything. And so we had all these holes and pulls and different, things we did to combat that. And at the end of the day, it's a really cool deal. We were able to build a rooftop deck. We had to save this, oh my goodness, 100-year-old live oak tree. It was like $125,000 just to move the tree into a courtyard.
Wow.
And get it to live.
And it lived, I guess.
Yeah. I mean, that's the hard part.
$125,000.
Oh my goodness. Like we had to bond around this tree, and you're like, please don't let this tree die.
Yeah.
But anyways, it was the first deal we did. And like we thought we were overpaying like crazy for this site. We had institutional capital that wanted to get back to Austin, so our yield could be a little more aggressive on it. We're like, all right, here we are. That site's probably worth 3 times what it is today.
That's amazing.
And it's just incredible. I mean, all that challenge and like what we built to that, we missed the peak of the market in Austin, but I mean, it would have sold for 2.5x the cost if we would have caught the peak on the delivery side of it. So it's like, again, timing is everything.
I'm sure as a developer, as you're saying that, you're like, if only. There's probably so many deals where when there's some that hit, but then there's so many where like, if only.
Well,
timing's off.
What's the difference between a garden deal built in 2019, 2021, and 2023? It's like, well, one of them's a 3x, one of them
hasn't
double your
sold
money,
yet.
and the other one you lost all your capital. You're like, but I built the same thing. Like it's a lot. There's so much of this that goes into market timing, and we all believe in our special sauce and why we're unique and this and that. But one of the guys that I kind of learned a lot from coming up through the business was always like, look, you just structure deals where if timing's bad, you don't have to give them back. Like, don't ever leverage to the hill. Don't ever use kind of the funny money financing tactics. It's like, if you do and you get caught, you're screwed.
Yeah.
And, it's kind of like a stock. If you buy a stock and it goes down, you haven't lost money until you sold it.
Yeah.
And so real estate, if you can, collect cash flow, as long as you can cash flow something and refinance it out, if you need the money, and I get time value and, hey, maybe I could sell it today, take a 10% loss and then put it into something that might double its money faster. So there's that whole concept, but it just depends on what you're working with. If it's you and me pooling our money together, we're looking for the highest and best use. If it's some of these institutional giants, that are sovereign wealth funds and pension funds that have so much money, they don't really need to take the capital back because they've got reinvestment capital to put out. And so just by avoiding the loss, they're making that spread. And so as long as you can cash flow it, you're okay.
Yeah. It's an aside, but it's one of the reasons why I know you guys are not looking to go buy land right now, and you're looking to close into construction because there's a lot of developers stuck in land.
Yeah.
And that's a tough spot to be in because there's no cash flow and there's only carry and taxes and all that. And so maybe it's a good segue into you leaving Fairfield, going to Endeavor, the timing, the whole market had basically flipped upside down on just what, the deals, guys were making a ton of money. We had wouldn't you say in your career is probably the most active building, like 18 months that we've ever seen post-COVID. It probably only lasted like 18 months, which is crazy. It feels like it lasted a lot longer.
Yeah.
And then things turned. And then you went to Endeavor and the market has stayed pretty difficult, which is probably a good segue into the deal we just closed. Cause it's like, you would think by 2026, it'd be easier to get capital. Concessions would have burned off. There wouldn't be so much supply, but you ran into pretty much all of those challenges on this deal. But maybe start by just talking about the change into Endeavor and the timing in the market and what's been going on.
2024 Zach knew what 2026 Zach knew today.
So I was thinking too, of all the deals we've chased over that amount of time,
It's incredible.
So many of the meetings we were in were like, but 9 months from now, it'll be different.
Yeah. Hindsight's always 2020.
Yeah.
When I left, I was at Fairfield for 22 years. It's all I'd done my professional career, and I'd worn a lot of different hats, but it was my job. It was like my professional family.
Yeah.
I'd seen multiple CEOs go out through. I'd been there just about as long as anybody in the company. I knew everybody, all the accountants, everybody in every division I knew. And I mean, I consider a ton of them. I still talk to a lot of them.
Yeah.
I'd known them for
you were
decades.
like a little kid when you started.
Yeah.
So they're seeing you as like almost a college kid, but like a high school kid.
Well, and I'd outlasted a lot of people. So I had a lot more seniority than a lot of people there. And again, just good people. So I really enjoyed my time there. When I was in Fairfield as a manager, I had hired a young leasing agent named Luke Philippi. Luke was one of my leasing agents. He ended up promoted to being a manager.
I bet he was
deals.
I bet he was a good leasing agent.
He was great. I mean, we all were really good leasing agents, right? Which isn't the greatest litmus test for a good developer, but every once in a while it works out. But so he and I mean, he was the manager on one of my first student housing deals. We worked together for 10 years, and obviously we were really good friends. He was in my wedding, and then he took a pathway away and started getting into. He ended up at the Alliance shop and did a lot of development there and got synced up with the Houston team. Mm-hmm. And he had this opportunity to come over to Endeavor. So we were obviously still talking a ton, and he kind of bounced it off me, and we talked a lot about it. I'm like, man, I think it's a great opportunity. Like, you need to go do it. And so he did, and he introduced, Endeavor. Prior to that, their multifamily experience was, hey, we build the nicest of the nice. Like, we're building the Taj Mahal of high rises. By the way, we sell them for a ton of money, and they just rode that wave, and they did awesome. I mean, made incredible spreads on these deals. And Luke introduced this concept of like, hey, wood frame development, it's not necessarily about hitting the home runs. You can develop a lot of deals, and you can volumize this. There's a whole other thesis off of this, and a whole other segment of the market that's untapped for you guys. So he built that division up, and that division requires a lot of people, and so he's hiring architects and civils, and he's hiring design people, construction people. Eventually, they started the GC entity and arm of it all. And so they were doing all this, and the whole time, Luke and I, they were talking. He's like, "You've got to come over to this shop. Like, it's incredible. You got to meet the people." And so him and I had talked about this for years, and it was always, I was doing a lot of stuff at Fairfield, and I'm like, I'm not like looking to jump ship. And so it was always just kind of something in the back of our minds. But ultimately, it kind of materialized into a reality. They were ready to say, hey, look, we're ready to move out of Austin and get somebody in Dallas. And that just sort of morphed into the opportunity. And so I made the decision to go over. And it was, for me, it was almost just like, it was like a shot of new life. And as great as my experience was at Fairfield, I had been there so long, I felt like I was just doing the same thing, talking to the same people, and it was very known. And my days were prescripted, and I knew what was happening. And so the opportunity in Endeavor, it had a little bit of nouveau factor to it, where it's like you can kind of build what you want from an infrastructure standpoint in your office out there in Dallas. And you don't have to get on a plane anymore and go to Austin. You don't have to go to Houston. If you want to, you have the opportunity, but if you just want to go do deals at home, you can go do that. And so I've got 3 kids. And so they're in the prime stage of activities and sports and things. And I'm like, all the money in the world isn't good for anything if you can't spend the time. Because I can't get that back. It afforded me the opportunity to kind of stay home. And it gave me the chance to sort of build the team and the business and the strategy. And it was no longer like the strategy is given to you, you go find it. It was, what do you think makes sense? What do you think you can raise money for? And that was exciting because it was a new twist on the same thing. Yeah. And so even though your bread and butter is how do you go put a site together and get it to work, I was doing all that at Fairfield. But you took some of the training wheels off because you got rid of the capital market support, you got rid of all this other support groups you had, and then it was more on what you build and what you can do to kind of recreate that. And so it was exciting. It was an opportunity to go work with a really good friend. And it just felt like the right time, for my midlife work crisis. Like, it was time to give a change. This was it. And so it was the opportunity, because over the years, you always have people calling you and stuff. And you're like, well, what's the difference between, pick a name out of the hat. If you take one, national developer, Dallas has 100 of them and everybody wants to be there. So you're like, what's the difference between working at TCR and Alliance and Greystar and Fairfield? And it didn't feel different, but Endeavor felt different because it was also a group of guys that does all this other stuff. Like they'll go buy ranches and subdivide it. They'll go do $8 billion redevelopment in Austin or Dog's Head, which is this master deal.
So entrepreneurial and just outside the box, raising land funds here and development funds and just all. We've been so impressed by the entrepreneurial nature of what they've done and how much the risk they've taken. You guys have taken in Austin. Pretty incredible. I'm sure right now that's like, once
again, hindsight 2020. But it is interesting because when I go down there, like we have an investment committee every Tuesday, and the people are amazing and they're really successful investors and they all have a different take on something. So it's a lot different than being in a shop that's 100% multifamily focused. Yeah. And everybody's an expert. So when I was at IC, you have a head of asset management, head of property management, head of construction, head of development. You have all these facets of multifamily that are giving you their opinions and their thoughts, and they're very targeted. And, sometimes I think we're all guilty of this, but we get so much into the weeds that we miss like just the 30,000 foot level of some of this stuff. Like Corinth is a great example. It's like when you look at it on an aerial, you're like, oh man, this makes sense. This is pretty cool. Here's what's happening in the area. Here's your accessibility, here's your visibility, all these are all these kind of things that make sense. But if you're sitting there looking at 2-bedroom rents and you're trying to figure out, does my unit need to be 1,100 square feet or 1,050 square feet, or do I have this allocation right or wrong? You're looking at it and going, the effect of that on my deal is so minute that sometimes you just get bogged down in the details. And with Endeavor, it's nice because you're taking sort of the top level approach and saying, here's the thesis on it. Does it make sense? And you've got really, really astute folks that ask really common sense questions that you just sometimes take for granted. Yeah. And so it's been a really neat change in dynamic. It's been great to be there. And they've been very supportive and welcoming of the new market and learning that new market, which was a big thing for me. And so definitely no complaints about that. It's been wonderful. But it really was just a really cool opportunity to kind of start something and expand, what's a newly created kind of thesis within their company with this whole wood frame, production frame deal, and see where we can carry it to.
Yeah. Well, it's neat too, just getting to work with Luke. We all have friends that are, hey, it'd be great if we could do something together. And you're like, yeah, that would be great, but it's probably never going to happen. And so to talk to him for that long, now it's probably kind of weird that now you've been working together for a couple of years. And it's like, oh, we did it. Like,
you're like, now we got to do some deals.
Now we got to do some deals. Yeah.
Prove that thesis out.
Stop. Now you're not selling me anymore. Now we got to go make it happen. Yeah.
Well, and I mean, in 2024, I think coming out of it, we thought, hey, there's this little blip. You got the election coming and Trump's going to come in and all of a sudden it's going to be all this capital investment push.
Rates are going to come down.
Rates are going to go down. We're going to have a great 24. I just remember NMHC that year, all the optimism. And then by the time we got to like June, it was evident nothing was happening this whole year. And so we're like, well, this is interesting. So, maybe let's take the rest of this year. Let's chase stuff, but I remember we took the deal out that we were looking at together. I think it was in Melissa, and we went out to 100 investors and we got nothing. There was not one investor out there. And you were like, this is pretty indicative of the market. And so, it was kind of a reevaluation of strategy. You get into 2025 and you have that same optimism. We're like, okay, 2024 wasn't there, but 2025 feels a whole lot better in the beginning of the year. And it just never materialized. It just didn't happen. And there were all the same challenges. You had all this kind of sticky economic data that just didn't support it. And you had, no help on rates. And we're still trying to put deals together. And it wasn't really until mid 25 that we got to that point where we're like, okay, we believe if we can find something unique enough that we can go get it capitalized. And, that ended up being, we signed up 2 deals, Corinth being the first one. We ended up getting it done. And that was the first time we were able to get an investor on board and really believe that this is the right time to go do it. And I think it was because it was part of this larger vision. And there was a uniqueness factor to it. And it's like, hey, you're going to actually be the only project that has pure lake views. And you're going to have this, really neat community feel with its own private lake and trails and everything. And there isn't a lot of natural beauty in Dallas. So if you can take advantage of it, it felt like, wow, this is kind of special.
Yeah. That deal had so many hurdles though, because it was supposed to be a pretty fast deal. Like it was supposed to come together pretty quickly. It just got zoned, and it was part of this, like you said, this really cool larger property that had been owned by some like international groups that hadn't been able to get their development off the ground, and a local guy came and bought it. Do you want to kind of walk through some of what you initially thought you were stepping into? Because this is probably like a developer's story is, everything's utilities, everything's figured out. It's ready to go.
Yeah,
come build it.
This sounds like the brokerage pitch when somebody brought it to me. They were like, hey, man, I think you can close and you'll be ready to go in like 4 months. I think, again, if I can take an overview on the whole thing, the only way deals in a challenging market, the only way deals get done is when you have a really open and honest relationship with the sellers.
Yeah.
And there's flexibility on all sides, because, that's a perfect example of a site where everybody had the right intentions, but there was a long list of things. And so when we first got into the deal, I think, we sat there and we said, okay, guys, it's zoned. That's awesome. Land use is in place. But because it's part of this larger mixed use development, because it's going to have simultaneous construction, here's a list of things we're going to have. We're going to have to develop CC&Rs that regulate the area. We're going to have a development agreement. We're going to need to understand what you're doing, when you're doing it, how much it's going to cost. There's going to have to be backup for all of these things. And it's not just for our, safety, but for us to go get a loan and a partner on this. We have to have this ironed out. Like our structure is institutional in nature, not, just me putting up a checkbook. And so it can't run off a handshake. It can't run off of these ways that sometimes these deals get done.
And the scale of this was big, just to give the audience an idea. I mean, because like you're talking roads, you're talking utilities, you're talking grading.
Yeah. So it was 120 acres of raw land with a, kind of a jacked up lake. And it had up to 50 feet of elevation drop throughout it. It had a lake in it. So there was floodplain. There was all this stuff, and it's all raw.
Yeah.
So there is the master plan that essentially envisioned 33 estate lots on one side of a private lake,
which are
acre lots.
Value of those was like, you're into the millions on those, right?
Just so the lakefront lots both sold for like $2 million a piece. Yeah. And they're building like $4 or $5 million houses on it. And then all the lots on the west side, they're all like $500,000 lots.
Wow.
So, I mean, they're for really nice
$2 million
homes. Yeah. And then you had like 240 villas and townhomes that were kind of wrapping the east side of the lake and the south side onto Lake Lewisville. You had commercial and like restaurant and retail uses all along the frontage of it. And then we had this multifamily pad site that was about 11 acres that sat up about 30 feet above the rest of the land. And so that was the idea. And
with no real way to get to it, right?
No, it's all just, you have, once you get into the development side, you had to get access to it. You had to have easements to it. You had to have dedicated public roadways. You had to go do all this stuff. And none of that had been built. And so we were supposed to close and start construction at the same time as really them starting construction on all these larger items. And so we did a ton of, and throughout all of this, they're trying to do some dirt work. And we actually, one of the things that we worked on together was, well, we have excess land or dirt on our site that's going to have to get cut off. You're going to need the dirt. Well, how do we get you the dirt? Because someone's got to pay for the grading for that, but we haven't closed on the site yet. So you had to really, negotiate a bunch of things, but you also had to really trust that your partner was going to be there at the end of the day. Because if we had never shown up, it would have been challenging for the seller.
Yeah.
At the same token, if they didn't do what they were supposed to do,
you couldn't do what you need to do.
Yeah. And so what started off as, hey, we'll close in 4 or 5 months once we get all this stuff ironed out, really turned into it's going to take a year, because getting through the design of all of that stuff, it's hard to identify cost responsibilities and scopes until you have it fully designed and approved, because it's always changing. And so everything that, I think that was in the beginning, everybody thought they were going to be able to do, ended up taking longer.
Yeah.
And so it was working together through that process, and just really, we have gone through that before. And I think for our seller, it was a little bit of a newer process they haven't done 20 redevelopments of master plan communities and things. And so there was a lot of like, okay, let's be sure we do this, and this. Like, okay, well, we'll go do that. And we just all work together to do it. And there's other users or people, single family home builders or guys interested in the retail or guys interested in the townhomes. And so, we'd have a monthly call where everybody's like, this is what I need from you here. And for us to go get initial permits and stuff, we had to get development agreements with other people done so that the city knew what was happening on the overall site. And so it was very challenging, but I think it'll make for a really cool deal at the end of the day. And you'll look back and say, sure, it was all worth it, but you probably think you could do 5 deals at the same time it takes to do 1 deal. But it wasn't like we could have done 5 other deals at the time.
It's just so unique. Yeah. I mean, were you guys quarterbacking a lot of I know there's obviously the master developer, landowner, but because Endeavor has so much experience, were you guys quarterbacking a lot of just the agreements and like taking first draft on a lot of those? Or were you more waiting and he was doing that?
I'd say it was both. I mean, they would come up, they would do a lot of the first drafts for stuff. And then, we would have a lot of kind of suggestions and comments and stuff. And like, how do things, for us, sometimes you get into a situation where you're like, well, things can't operate like this. What does work for a single family HOA doesn't work for a POA when you've got multifamily into it. And it was an eye-opening experience, I think, to the broader view of what some of the more commercial property has to do. It was a very involved process, and it was a little bit of both.
Well, it's so valuable, you guys taking the role that you did. Because I'm just thinking we have landowners that'll have these large properties. Every landowner wants to look at their 50 acres and be like, I'll just sell 5 acres 10 times for 5 times what I would sell.
Right.
And it's like, there's so much coordination. Also, that might not be feasible, but there's so much coordination. You got to have roads and utilities and zoning and everything. And you guys really being there early in this deal and being a pretty big piece of it, being able for, like you said, for you to be there for the landowner to kind of help make sure it was all done correctly.
Yeah.
Having that trust with each other is so important versus just saying, well, you didn't close in 4 months.
Yeah, we're
kicking you out. We're going to go to the next guy. And the reality for a lot of landowners is unless you're just in a really hot market, like we were in there for 18 months, which I don't know when it's going to come back, if it will. And if it's just going to be people are just buying sites because they're zoned and figure it out later. But we haven't been in that kind of a market for a long time. And so it's so important to find the developer that you can build a trust with. But Tim and I run into this a lot. There's a lot of landowners that they're just very distrustful of developers.
Sure.
And they feel like, and some developers, maybe you shouldn't trust them, but but there's a lot of we meet with a lot of great developers. There's a lot of really good, they're not the big bad, developers. And if you're able to build that relationship instead of just constantly feel like Zach's trying to screw me over, he's trying to, take advantage of me or whatever, and hear out like that you have a challenge or an issue or something you need. I mean, we see that all the time where almost no deal closes with no problems. I wish it did.
Yeah, you're right.
Pretty much every deal we do, you need more time for something. And sometimes buyers are trying to take advantage, but a lot of times it's very legitimate. And so I think what you said just about that, like finding a seller that's willing to work with you in this kind of market is so important.
Yeah.
So important.
It's funny you say that. And this is no malintended for architects in general, but like it's always funny when you get like an architect's layout of a master plan community. And they're like, hey, this is what it's going to look like. And it is this beautifully crafted SpaceX type thing. And you're just like, man, that's really cool. And then ultimately you get into it and when you get into the civil side of it, it's like, oh yeah, well, we just assumed you'd go take the floodplain in by 100 feet. Oh, we just assumed you could get a variance from the setback. Oh, we didn't know that there was a utility easement that went through here. And you're just like, I mean, if you don't take into account the real constraints, you're spinning your wheels on what could be. I mean, you may take a year and a half and spend a bunch of money rerouting utilities and working with LOMA or CLOMA or something with the Army Corps of Engineers, and you could get there, but like it may take 5 years to get there.
Yeah.
So it's always a challenge when you try to deal with the reality of the constraints versus the potential for what somebody can draw. And that is always, I mean, we always have civil and architect trying to go line in line, lockstep from the beginning, because that is, without that, you get a lot of finger pointing later and it's like, well, this doesn't work. And I mean, it's one thing when you have a bigger suburban site where you can like just, we'll move that building 10 feet to the right and it'll be okay. And maybe we lost a couple parking spaces. urban deals, 6 inches, a foot can make a big deal.
Yeah.
And so I think it's always a challenge to try to marry those up.
One thing I was going to ask you is, where do you see the next, call it 18, 24 months for the multifamily business? With Kevin Warsh taking over at the Fed, it doesn't seem like rates are going to go down in the next couple of months, but I'm hearing maybe 50 basis points end of the year and then maybe some more cuts next year. He's going to try and bring rates down. Do you think that allows for a lot of developers to sell off all these legacy deals and just create, cycle back a lot of liquidity in the market?
I mean, it's a great question. And, I told everybody in NMHC in the beginning of the year that the outlook was pretty positive for some rate cuts.
Yeah.
And then by March, I went, gosh, I was wrong again.
Well, the war didn't help, but
yeah, it was just and again, I mean, you sort of look at that and look into the future, and then something like the war happens, and you're like, man, definitely didn't see that one coming. Like these, that's maybe not a black swan event, but it's one of these just things that happens that you just don't really know how that's going to affect and play into things. And I've sort of succumbed. I mean, when I looked at it at that point, I didn't see there being a lot of support for rate cuts this year. And I mean, so much of it depends on the economy. And I just, we get spoiled in Texas because we think of economy from a localized standpoint, not a national standpoint. And our local economy, I mean, DFW, it's like we still have a ton of job growth. We've got new headquarters getting announced daily. There's so much. I mean, I talk to guys that are in the office space that are like, man, we've got some big things coming. And, it's just, there's all these things that sort of cloud you to what's happening in the overall sector. Because I can tell you in Indianapolis or Cincinnati, it's a lot different. And even in South Florida or, California, it's just a lot different than where it is in Texas. And so from a micro level, I see there's being all of these good, positive reasons to continue to go. But when I think about it from a macro level, just like the overall country, with the things that you just mentioned, I don't see there being a ton of rate cuts. I mean, unless you start really seeing unemployment spike, unless you start really seeing consumer confidence dip. I mean, we've had some of the lower levels of consumer confidence, but yet GDP isn't showing that. The numbers aren't really showing that. And you've got all these pressures now with inflation. And I think that balance between trying to manage inflation from going through the roof again, like if you went ahead and cut rates, 50 basis points at the next Fed meeting and started pushing all this construction spending coupled with oil prices going and energy prices going through the roof, you kind of think you're just going to be right back into, if the environment supported it with lower rates, then do costs to start running away from us? We can't make the deals work. Yeah. And that's the bigger issue to me. I think right now, the paradigm that we live in is it's really hard to do deals, but it's hard for a reason. And we are still working with absorption, concessions. We're still trying to prove out rent growth as a real positive thing. And I think obviously DFW's kind of rebounded a whole lot faster and didn't have the same lows that some of these other markets did. It's probably one of the best performing markets in the nation.
Yeah. Even with the challenges we still feel like we have. Yeah.
And so, I mean, you go look at new permit issuance, it's down 70% year over year. And so at some point that does meaningfully impact occupancy rates, rent growth. I mean, Austin, there might have been 8 deals done in Austin last year, the whole metro. That's down from 20,000 unit starts. Yeah. And so you compound that for a couple of years and say, all right, 2026, it's kind of the final wave. Like the absorption in Austin's been crazy. But you got people that are offering multiple months of concession with gift cards. And I mean, you're incentivizing people. I mean, nothing beats, like you can't build a pool that's cooler than 4 months free rent. Like it's pretty awesome. Yeah. So you're looking at that and saying, okay, when that product gets absorbed and then you begin to start seeing the growth, does that checker bound look like 6% growth annually, 9% growth annually? I mean, we've seen crazy numbers in Austin because it's so small. You're never going to see that in Dallas because you can't have 8% growth on 8 million metro. It just doesn't happen.
What about Houston, Zach? Why do you think Houston's been so soft from a rent standpoint with pretty low supply the last couple of years? I think we're averaging like 14,000 units a year the last 3 years.
I think it's partially because Houston always runs at a lower occupancy. I mean, Houston always kind of hovers around 88 to 91% occupied. And then like there's dips where it goes really high. But you just, again, if you take 2-3% of occupancy over 8 million people, I mean, it takes 40,000, it takes a lot of units to fill that. And I think that to me is the difference. And Houston is so spread out. It's similar to Dallas in that veil. And so you really have to look from a micro standpoint because what's happening in, the Woodlands and then what's happening downtown or what's happening in Pearland, like it is not indicative of what's going on in any of these other metros. And so you can get metros where you've really oversupplied, concessions are a problem, and you're still eating out of that. And I mean, that's true everywhere. But as you get into these really, really major metros like Houston and Dallas, it's so much more regionally focused. Dallas, I'd look at Mansfield. I think Mansfield's really cool. There's a lot of really big capital projects and new companies going there. And, a lot of entertainment building. Like there's really good fundamentals happening. There's been like 3,500 units delivered the last 3 years, and there's 8,000 left to go. Yeah. And we looked at a site there. I think it was with you, Tom, and we actually brought it in and we had this conversation internally about it. And we're like, man, even this is the trap that we've fallen into is how do we justify doing a deal in a market where there's just a ton of supply and a ton more supply? Yeah. And it wasn't getting absorbed as quickly as we wanted to see it. McKinney is another market where we see a ton of product, but it's been absorbed. Mm-hmm. So we've seen rents soften there, but we've also seen, 3,500 units delivered, 3,800 absorbed. And when we look at the horizon on McKinney, we have a site, it'll be the next deal that we actually close and start for Endeavor. But within, call it 2 miles of our site, I mean, there are multiple $100 million projects with an amphitheater coming in and hotel convention center coming in, a surf park coming in, the brand new JW Marriott coming in, and you
Costco, HEB, Kroger, all these massive,
And like when I think about those developments, I mean, it's really cool when Goldman Sachs announces they're going to go downtown and they're going to bring all these people, and these are high paying jobs. Well, that's great if you're going to go build a high rise, in Uptown. But for us building apartments in McKinney, if you go have a bunch of people making $250,000 a year, that's not my market. So if I get 5,000 high earners, it's not helping me really. It's not identifying like a renter's market up there. They're going to go buy $750,000 homes. But when you build hotels and you build service, entertainment items, you go to these amphitheater, it's supposed to employ like 750 people. These are servers. These are hospitality folks. I mean, they're service-related industry. These are apartment renters, the airport expansion, like all these things. These are people that are going to make 75 to 125,000. If we build a really nice apartment, this is our demographic. So we've got 5,000 jobs within 2 miles coming in the next 2 to 3 years. That's an unheralded amount of growth. Yeah. And so we feel like that's the right time to get in front. And by the way, there also are not 3,500 units starting this year.
That's right.
Gone down to like, there's 2 jobs starting up there. So you feel really good about being one of the 2 or 3 that gets going during that time in a market that's shown that it can absorb as a consistent just growth tactic. And then you add all this demand and you feel like that's going to support it. And so again, I think it's a very specific reason why we could go do that deal. I think Houston, there's pockets that we particularly like. And it's funny, I think the most successful deal I've ever done in Houston will be that high rise off Waugh. I mean, they're getting great rents, which looking back, I'm shocked that that's held of everything out there that's been soft. You're like, really? The high rise is the one that did it? Yeah. And it got it at such a good basis. And it really is a nice product.
Very location,
probably one of the nicest things we've ever built. Yeah. And it's just held up. But to your point, like, I don't know if I could sell it for a huge, if that was in Austin 2 years ago, I might have broke a state record. But today you're looking at it for that deal. I mean, I'm invested in that deal still. Our partner's a long-term pension fund. And in 10 years, it's going to be a fantastic deal. And it just is funny to me that if you would have drawn out your wrap in Austin or your garden deal in McKinney, Texas or wherever, and stack that up to the high rise in Houston, I don't think anybody would have pushed their chips on the high rise. Yeah. That was the green 00 and it hit. And you're just going, wow. But I think it's very segmented in Houston. You just got to pick and choose your battles. We think there's some opportunities in suburban Houston.
So do you want to try to finish your thought on Houston? I think you were talking about suburban.
Yeah, we think like today, that market, I mean, there's still a decent amount of infill development. And so I think where can you go and try to get away from some of that supply? And I mean, that inner loop, like the employment picture is so strong, but it's just the supply picture is so strong. We see that's where a lot more of the sensitivity is, and the cost to develop in there is just high.
Yeah.
So it seems like that's more of a long-term hold type strategy. And if you are more of a yield-seeking merchant builder, it seems like the suburbs, you could still find deals that are priced right and you can execute a lot faster. And so I think that's kind of where we want to play in Houston.
Yeah, and there's some barriers to entry in some of those suburban markets too.
Oh, sure.
Where you go to Pearland's really difficult, but you can get a deal done every couple of years down there. And same thing with maybe like Friendswood, which makes it interesting. What do you think is going to happen with just a lot of these deals that have just been like on the proposed pipeline across Dallas? So they're already developer owned, but they've been developer owned for like 3 years. Do you think, I guess it depends, right? If it's like Davis Development, they can just hold and build in the future, but a lot of developers aren't set up that way. And maybe they used debt, maybe they didn't.
I think you're already seeing, I mean, you've seen over the time frame, like some of these sites that have come back. The problem is it's just whatever was bought 24 to 36 months ago, it's just not worth the same value. You bought it on the upslope, markets have corrected, and there's a time issue there. And so you either have to restructure it and hold it. And what I think we've certainly seen this on the existing product side. The reason we haven't seen the sales is because the liquidity in the bridge market has come back. I mean, it is so strong right now. And you can refinance out deals that I would say probably have very little equity in them today with a $0 cash out and just extend it out for a couple of years. And they'll still meet the cash flow requirements. So you're cash flowing enough to pay a little higher interest rate. And so if you're an owner of an existing asset and you've got money tied up, there's no real reason to sell.
Yeah.
And so you have all these people that are kind of pushing it out, waiting for that rent recovery where they can go get their money back and do it all. And developers, I mean, our promotes are all gone on those deals because your pref's getting eaten away. And so I think we've seen a lot of people that finance deals with pref money getting refinanced out with this bridge money. I think the deals you're seeing going into production today, there are some JV deals getting done, but they're few and far between. A lot of the deals that are happening are these kind of mezz deals or preferred equity deals that are coming in and filling that gap, and you're having developers have to take top end risk, put up a little bit more. Maybe they're raising friends and family cash to make the top 10, 15%. And they're putting in land, they're putting in fees, they're doing whatever they can to do that. And that's how I see a lot of deals that are actually happening right now. Then you kind of have the other segment, which is people that are just holding on.
Yeah.
I haven't really, again, it's like the land world's always the last one to get the message. And so it's still, you talk to somebody and they're like, I don't know, this site 2 years ago traded at X per foot. And you're going, well, nothing's happened with it and it's not going to happen. If you want to sell today, you got to sell for N-1, not N+1. And that's just hard. And it usually takes a couple of years of separation where they can be far enough away from that sale where it's just not present in mind. It's a really, the land game is a tough one. There's a lot of people that have owned for a long time and don't have a lot of pressure on having to sell. Or they just, to your point, they've got the capital and it's all paid off, or they just pay off their loan or they recapitalize it or something. And so I haven't seen a lot of distressed land, and I just don't anticipate seeing it.
Yeah.
I think it's more of a hold and pretend because people realize there's value in it. And a lot of times the land isn't a huge component. So for a land seller to sell for $15,000 a door versus $25,000 a door is really meaningful to them. But maybe that's $3 million on an overall deal. And so,
it's more like, can you capitalize a deal at all? Right. At any price,
right?
More than does it work at?
Yeah, I mean, we talk about this in some sites where I'm like, you can give me the land for free, and I can't build that site.
Yeah,
and nobody likes that, but that's why we all choose and play on it.
It's hard with some of these markets, like a Celina or Melissa, or the markets where if you found a site that you were interested in, you felt like there's a story. Then you have to answer the question like, well, these 10,000 units that are planned up here, that it's like they probably aren't going to get built anytime soon because it could be a site that's way off the beaten path, but a developer bought it like in 21 saying they're going to build it. Or it could be like a pretty good site, but it's got utility issues. How do you play that game with capital where you want to be honest about what could be coming, but then you can't show like, Joe Smith over here owns a site that he says he'll build. He's been saying he'll build it for 3 years, but he's never built apartments. Like, how do you show him pipeline report?
We analyzed this, and I would tell you, in all honesty, it's an impossible conversation.
Yeah.
And even within our own internal kind of committee and review process, we talk about supply, and one person will be like, I want to see all the deals that are out there potentially.
Every zone
and then
site
you put this aerial together and you're like, all right, here's every site out here, and here's what couldn't cost. I mean, what's going on with them.
Yeah.
But just because, somebody entitled a site 3 years ago for 500 wrap units in a market that has no wrap product, you're like, I call this like a stoplight analysis. We've got like red, green, and yellow. And I'm like, the red stuff, maybe it's zoned.
Yeah.
Maybe it could be a potential, but it's been under contract 3 times. It's never happened. It failed because of this, or it's at a super high basis and you just can't see it happening. Yellow is kind of like, well, we know that so-and-so's out there trying to raise money for it, but they've been doing it for 12 months and they haven't been successful.
So you never know.
And so
probably not.
Could it happen? Maybe. And then green is like, hey, these guys are going forward. They have capital. And so we try to look at that. But I've talked to so many different capital shops, developers, people like, how do you analyze supply? And there's just no mechanism to really understand if it's going to, crush your deal or help your deal. I've been in markets where you've had 3,000 units of supply and it's been a great performing deal because you had that demand cycle for it. And I've had deals where there's no competition and it didn't end up working out.
Yeah, there wasn't a market.
So supply, I think it is still the number one thing on everybody's mind.
Yeah.
And whenever I talk to any capital group, they're like, okay, tell me what's about it. And I think what we've been able to do is just sit down with people and say, we know what's going on. Here's our thesis on every single deal, on every single site. Here, like this guy owns this one, this guy owns this one. Here's what happened here. Here's why we don't think. And we have to be really specific about we do not think this is a problem and here's why. And they have to formulate their own opinions. We tend to over-inform versus under. And that can be tough. Like we've had investors go, I don't know, it's just too much for me to handle, and they'll walk away.
Yeah.
And you're like, maybe I should have just said nothing under construction.
You'd rather not them come back later and say, hey, you knew about those 2 deals and you didn't mention
It's always better to make an informed decision.
Yeah.
I kind of feel like even if and I think even internally, sometimes we see the eyebrows go up and everybody gets concerned. But then by the end of the conversation, people are kind of like, okay, I get it. I get why we would be able to perform here. But it's sometimes kind of a long journey to get there.
Yeah.
Supply is tough though.
It is tough. To your point, there's some subjectivity to it. It's not fully black and white. But man, thanks for coming on the podcast today. This has been really fun.
Yeah, I appreciate it. Thanks for having me, guys.
We'll have to give Luke a hard time that you beat him onto an episode.
I think it's right time, right place, right?
Thank you for listening to our podcast today. If you have questions about land you own in Texas, send us an email at texaslandguys@dmre.com and follow us on LinkedIn to stay updated.